everyone, and thank you so much for joining me today to learn about Mega Roths. What are they and how can you use them or benefit from them? So this is going to be a webinar that I sort of consider more of an advanced strategy. So if you're joining us today to learn about it and you are not familiar with Roth conversions, Roth IRAs, or solo 401ks, please, I would encourage you to stay, but definitely go to our YouTube channel and check out webinars that we have done on those other topics as well. I think that will really help you in understanding the topic more that we're going to discuss today. My name is Larissa Green, and as we go through this, I want to welcome any questions. Please feel free to type any questions into the question box. I will be monitoring that throughout today's webinar. I do keep all attendees muted because we do record this and it just makes for a nice clean recording, but please feel free to get any of your questions typed in there. I also want to mention that I added the slides as a handout. So when you're looking at sort of your control panel there, you'll see handouts. If you click on that, you'll be able to download the slides and either follow along, take notes, or save them for later. So I just wanted to let everybody know about those things. Here's my information here. I've been with Advanta IRA for almost 10 years now, and I've been doing business development, marketing, sales sort of position for probably about 8 of those years. Prior to that, I did work in the back office handling things like opening new accounts, assisting with transactions, transfers in and out, check coding, and all of the things that sort of make up Advanta IRA. So I'm very familiar with the process behind the scenes as well as investing because I also self-direct my 401k. So I have my contact information up here for everyone. If you have questions, maybe more specific to what you're looking to do in your personal strategy, please feel free to reach out to me. I'd love to hear from you. And I'll put my contact information up at the end again as well. A little bit about Advanta IRA. We have been in the business for nearly 20 years, and we are nationwide, meaning that although we're in the Tampa Bay area of Florida and our other office is also in Atlanta, Georgia, we can work with anybody nationwide that has a US-based retirement account. And even if people live abroad, as long as their retirement account is US-based, we can help them self-direct. So it's not, based on where our offices are located. And I mentioned we've been in business for almost 20 years. We have a little over 1.5 billion in assets under management. We have close to 8,000 clients. And in that, and it's important to note that we're talking about self-directed accounts. And so we don't sell any investments at all. So keep that in mind. What we do instead is hold the account and allow you to find those investments that you feel comfortable with and maybe that you know best and invest your retirement account. So your strategy is your own. We only hold private investments, so anything outside of the market. And I'll talk about investment options very briefly at the end, just to give you an idea. I mean, we are a self-directed IRA administrator. After all, we do want to mention the freedom that a self-directed account will give you. The biggest difference between us and our competitors is that when you have an account with us, you do get a dedicated account manager assigned to you for the life of your account, which provides you really sort of that concierge style service where you pick up the phone, you know exactly who you need to reach out to when you have questions, everything from transactions to contributions, all the way to maybe paying expenses on behalf of assets within your account. So that's sort of how Advanta is different. And then of course, our education seems to stand out. I'm very proud of that. And so, today's webinar is something that we're sort of doing that is unique. I don't think we've done this topic before, but last week we talked about solo 401ks. We're working on a webinar on cryptocurrency. So we're always trying to keep everything that we're doing current and relevant and answer any questions that we have. So, we might have somebody that reaches out and says, I just don't know about a mega Roth. What is that? And we think, you know what? A lot of people probably have that question, so we should definitely do a webinar. So if there's any topics that you guys would like to hear about, please let us know. We would love to hear from you. Something I do want to mention is that we do not provide investment, tax, or legal advice. So a lot of times we talk about rules and strategies, but it's always good to consult your professional team. So talk with your CPA, your attorney, and investment providers with any questions you have. Be sure to do any due diligence on any investments you plan on making, feeling comfortable and understanding that investment and the rules that go along with those investments. If you do not have professionals on your team that can help you with that, let us know. We can refer you to professionals that our clients have used in the past. So again, if you have questions, just make sure you type them into the chat box as we go into the question box, and I'll be answering them as they pop up. But there's some takeaway points that I always sort of like to highlight, some of the most important points here, because especially with today's webinar, we're really going to be talking about some detailed strategies. And so most importantly, something to remember, there are many ways to contribute to a retirement plan for tax-free growth. So we're going to talk about them today. And I'll also talk very briefly about, I'll mention other types of accounts that this would work for and things of that nature. But just keeping in mind that, if you haven't been able to contribute to a Roth in the past, or you're not sure if you can now, there's ways to still contribute for tax-free growth to a retirement plan. Contributions to a Roth IRA have an income limit, but it is still possible to contribute, so we'll talk about that. And it's important to understand when contributions are allowed and the steps to take in order to make them. So, we're going to talk again about Mega Roth contributions to a 401k. We're going to talk about Backdoor Roth IRA contributions. There's a few steps involved in each of these strategies. So what does that look like? When do you reach out to your CPA? How do you make sure you're doing the proper filing? So we're going to talk about all of that right now. So let's get started. I want to start with the 2021 contribution limits. And the reason that that's important is because you're going to see that, especially with like a Roth or a traditional IRA, it's possible to put money in each year as long as you have earned income, but it's not a whole lot of money. So $6,000, it's a great way to contribute every single year. But a lot of times people will say to me, well, that's it. That's all I can put in. I'd like to put in more. How do I get more money in? So we're going to talk a little bit about that with the Mega Roth solution to that. But you can also see there's other employer-based plans, for example, that allow larger contribution limits. They may allow you some deductions, but when you're starting to talk about Roth IRAs, a lot of times people will call them after tax. I like to designate them specifically as Roth because, as you'll see later on, after tax could have a different meaning depending on how you're making the contribution. But the point being that it grows tax-free. And so that is a huge advantage to the Roth IRA or the Roth component of your 401k. You're going to have tax-free growth on that money. And that's usually what the appeal to those accounts are. You're not going to get those deductions that you would get with a traditional IRA, with your SEP IRA, or with the pre-tax portion of your 401k. But at retirement, when you take distributions, they're going to come out tax-free. So what is a backdoor Roth IRA? Well, there are income limitations for individuals and families that wish to contribute to a Roth IRA. These limitations are going to be based upon your modified adjusted gross income level. And I know what you're thinking, what are those modified adjusted gross income levels? I do have a slide on that, so we'll get to that next. But depending on your filing status, and I do have a description of that as well, you may or may not be able to contribute directly to a Roth IRA. So if you make over this certain amount filing every year, then you can't put money directly into a Roth IRA, but it is still possible to contribute using a backdoor Roth. You would contribute to a traditional IRA, which has no income limitations, and then do a Roth conversion to move it over to the Roth IRA. So that's why they call it a backdoor Roth. So you're going to the traditional, but ultimately you're moving those funds to the Roth IRA so that they can grow tax-free, as we discussed. But make sure you understand that the modified adjusted gross income levels do change every year. And so if you're thinking about last year and maybe you're already familiar with the strategy and you know what the income levels were for last year, they do get adjusted every year. So just make sure you're checking the IRS website or consulting with your CPA to find out what they are. And so on the next slide, I do have those for 2021. So I know it's still possible to make your contributions for 2020, but your conversions would be in are a little bit different. So we're going to talk about 2021 specifically. And so these are the modified adjusted gross income levels for Roth IRA contributions for 2021. So if you're married, filing jointly, or a qualifying widow or widower, 198,000 to 208,000 is the modified adjusted gross income level. If you're below 198,000, then you can contribute directly to a Roth and you don't have to worry about it. The backdoor Roth isn't a strategy that you will need to utilize because when you're making your annual contribution, it can go directly to the Roth IRA. If you're between 198,000 and 208,000, you can still make a Roth contribution, but it is going to be prorated. So that's important. You're going to have your CPA help you with a calculation there to see what it is that you would be able to contribute based on that $6,000. So, that's important. Again, if you're between 198,000 and 208,000, it's going to be a prorated amount. You can still make the contribution, but it's not going to be the entire 6,000. Married filing separate, and it's further described as if you have lived with your spouse at any time during this year and you make less than 10,000, you would have a prorated amount, a prorated amount to make the contribution. And I don't think I put that note here, but if you make less than 10,000, there would be a prorated amount based on your income. If you make over this amount, you cannot contribute directly to the Roth IRA. So this is where, again, the backdoor Roth IRA would come into play. And then if you're single, head of household, or married filing separately, and further described as, and you did not live with your spouse at any time during this year, the modified adjusted gross income levels are listed here for you, 125,000 to 140,000. So anything less than 125,000, you would be able to contribute directly to the Roth IRA, and you do not need to use a backdoor Roth strategy. If your modified adjusted gross income level is 125 to 140, again, you're going to have a prorated amount that you can contribute. Anything over 140,000, you're going to be unable to contribute. And again, this is where you would utilize the backdoor Roth IRA strategy. And I also wanted to let you know that I did pull this information directly from the IRS website, so I included the link for you down there. If you wanted to learn more about it and sort of read what their descriptions are, you can go ahead and do that by clicking on that link. And give me just a second, guys. I hate to have some dead air here, but I did have some questions pop up. I wanted to check the question box. Okay, I had some questions about the 401k, so I'm going to hold off on those because we're going to get to that in just a minute. What if you contribute to the Roth IRA and then your modified adjusted gross income level is higher? What happens? So that's a great question. So if you start, let's say we're talking again about 2021, and we're really just in the first month of 2021. So what if you say, okay, well, last year I didn't make over the modified adjusted gross income level, so I probably won't this year, and you make your contribution in January, but then you get to December and find, you know what, I did make over the modified adjusted gross income level. What can I do? You're going to want to get with your CPA, and you may be able to recharacterize that contribution. There's going to be some extra steps involved, but it might have to get recharacterized to traditional. But it is definitely something you want to work with your CPA on, and it does happen. I had another question pop up about making a spousal non-deductible traditional IRA contribution and then do the Roth conversion. And for those of you that are not familiar, a spousal contribution is just that if you have a spouse that stays at home and does not work, that's what a spousal contribution is. As long as you have the earned income to cover making the contribution for them, then you are able to contribute them even though they themselves do not have the earned income. And yes, the strategy would work for them as well. So let's talk about what this strategy looks like. What are the steps for making a contribution to a backdoor Roth IRA? So a contribution is basically the amount you take out of your pocket and put into an IRA account every year. And I always like to clarify that because people will say, well, you know, what if I invest in XYZ and the earnings are over $6,000? So I don't want you to confuse that with earnings. Earnings are unlimited. So if I invest in, say, a rental property and the rent is $1,000 a month, so I had earnings of $12,000 this year, well, that's already well over the contribution limit for a Roth IRA. Well, earnings are unlimited. We're not talking about that here. We're talking about money I take out of my pocket, I put into my Roth IRA every year. It's going to be limited to $6,000 and also based on my earned income. So if I didn't earn $6,000 this year, then I cannot contribute $6,000 to my Roth IRA. And that's important for you investors out there who may not have earned income. So again, talk to your CPA, make sure that your income is considered earned, because if you have passive income, a lot of times rental income or interest income on mortgages is not going to count towards your earned income and help you make those contributions. So step one, you're going to make and again, this is the backdoor Roth contribution, how this works. You're going to make a contribution to a traditional IRA. So it first goes, and again, this is if you are over the modified adjusted gross income level for the year and you still want your earnings to grow tax-free, you want them to go over to your Roth IRA. So step one, you're going to make your contribution to a traditional IRA. The next step is converting the contribution to a new or existing Roth IRA. And then the next step is going to be, or the last step, checking with your CPA on any tax implications. What happens when you do a Roth conversion or you move money from a pre-tax account over to a Roth IRA or the Roth component of your 401k, and we'll get to that shortly, is a 1099 is generated. And that's very important because you need to understand how that will affect your taxes for that year. So the conversion is done for the current year. And so that amount that you convert is brought into ordinary income for you. So here's sort of the special considerations. Moving money from a pre-tax retirement account to a Roth IRA is known as a conversion, and it is a taxable event. It's important that you understand that it is a tax burden to you and not to the IRA. A lot of times when people are doing Roth conversions, they say, well, I'll let the IRA pay for it, and it just simply isn't that way. So for example, when we have a client that does a Roth conversion, that money, as it goes from the traditional to a Roth, generates a 1099 that we send to the client for them to pay that tax bill. So in this instance, the $6,000 is going to appear as ordinary income to that client for the year the conversion is done. And you want to make sure you understand that. And here we're just talking about $6,000, so it may not make a huge difference for many of you. But when we start talking about, contributions to a 401k, for example, where they're larger, or if you have a larger amount in your traditional IRA and you wish to convert all of it or a large portion of it, again, it is 1099 income to you, and you want to make sure that you understand that so that when you do the conversion and you're not surprised by the 1099. If you or your spouse are involved in a 401k through your employer, contributions to a traditional IRA may not be tax deductible, and it's based on a modified adjusted gross income level. You'll also want to check with your CPA on how this will impact you. So and I'll use myself as an example. Let's say that I contribute 100% of what I can contribute to my 401k through Advanta IRA. And I want to make a contribution to a traditional IRA. If my modified adjusted gross income level combined with my husband's is over that amount, then my traditional IRA contribution will not be deductible. And in an IRA, they call that basis, and basis has to be tracked on an additional tax form. So again, something important to know. Or usually what I say to people is check with your CPA because they're really going to help you with this. They're going to file those additional forms for you and help you understand how that works. And this may not affect you at all if you're under the modified adjusted gross income level, but if you are over it, then you definitely want to make sure you understand that and how to track that. If you have any other traditional IRAs anywhere in existence, your Roth conversion is prorated. And again, talk to your CPA about this and how it will affect you. So back to our example of taking our $6,000 contribution. So I put $6,000 into my traditional IRA. When I convert it over to a Roth IRA, let's say I open a brand new traditional IRA with Advanta. There's no money in it. I contribute my $6,000. I create a brand new Roth IRA with Advanta. I do the Roth conversion of this $6,000, but at my brokerage firm, I have an existing $100,000 traditional IRA. That $6,000 that I moved over from my traditional with Advanta to my Roth Advanta at Advanta, even if it was considered non-deductible, it's not going to be a tax-free movement of funds. So that's very important. Again, speaking to your CPA is the best way to handle that. If you have no other traditional IRAs in existence, then you don't have to worry about that. And 401ks do not come into that prorated calculation. Give me just a moment, guys. I see a few more questions coming in here. More questions on the 401k. So I'm going to hold off on those because we're going to get to the 401k, and that may answer some of those questions. Okay, so I did just want to touch a little bit on the solo 401k before I jump into the Mega Roth. Many of you on this call are going to be very familiar with the 401k, or more specifically a solo 401k, but I want to touch on it, and in case you have maybe sort of kicked the idea around of having a solo 401k, but you haven't pulled the trigger, and so you are sort of wondering, will the strategy work for you and such, we will go over this very quickly. Keep in mind that when we talk about the components or the benefits to a 401k, not all plans have all of these components. The plan actually has to allow for these components in order for it to apply to you. So if you have a non-Advanta solo 401k, you want to check and make sure that as I kind of go through these, maybe make note or take this slide and go to your 401k plan provider and say, does my plan have this? Does my plan allow it? The other thing that I want to mention too is that the Advanta 401k plan has all of these components. The newest component, which is the employee after-tax non-Roth contribution, which is very important for the Mega Roth contributions to work, is a newer component that we added. If you did not adopt the plan in 2020, please reach out to us so that we can have you adopt into this newest component. But a 401k plan does allow higher funding limits on an annual basis, and I'll show you a slide on that as well. It will allow you to defer employer contributions, employee contributions, and also now this employee after-tax non-Roth contribution. And again, that's important for the Mega Roth. And don't worry, I'll explain those contributions to you. The plan can allow rollover opportunities, so old employer plans, pre-tax accounts of any kind can go into a 401k. The one exception is a Roth IRA. Unfortunately, a lot of people ask me, well, if it has a Roth component, why can't my Roth IRA go into the 401k plan? And the answer is the IRS simply doesn't allow it at this time. I don't anticipate them making any changes to it, but that would be nice. But no 401k plan can accept Roth IRAs, existing Roth IRAs. Access to tax-free loans, so different than an IRA, which you cannot borrow from, a 401k, as long as the plan allows it, gives you access to a tax-free loan. So you can borrow $50,000 or 50% of the value of your account. It escapes UBIT tax for leveraged real estate investments. And again, this webinar is not on 401k, so I'm not really going to go into that. But for those of you that are familiar, if you have purchased real estate with leverage, IRAs are subject to UBIT or unrelated business income tax. 401ks escape that for leveraged real estate. UBIT will be exposed, or it is exposed to UBIT in other scenarios, but not on debt leveraged real estate, excuse me. There's cost-effective administration in a solo 401k. It's much cheaper than having a larger plan when you have no employees. If it's you, your partner, or your spouse, then a solo 401k is a huge benefit in that way. You can have the Roth 401k, or basically the Roth component to your 401k. And as I mentioned, you just want to make sure that if you don't have an Advanta plan, that your plan allows all of these components. And again, if you adopted your Advanta plan prior to 2020, reach out to us and make sure you opt in for the employee after-tax non-Roth contributions. I had a question on solo 401ks versus Qrps. That's a great question. I get that all the time. What's the difference? A 401k plan is a Qrp. And I think that a lot of times there's a confusion there, but it is a qualified plan. That's all that is. A 401k sort of falls under there, along with some other types of plans. But really, if you're looking to make those contributions, like I said, the 401k has it. And then again, all of these components can be found in plans specifically. If you have more questions about that, let me know. I had a question, does Advanta handle backdoor Roth conversions for clients? Yes, we do. It's not something we do automatically. Of course, everything is self-directed with Advanta. So you have to reach out to us, talk to us about what it is that you would like to do, and we can certainly help you with that. If we take distributions from a non-Roth IRA, do those distributions count as earned income? Yep. Whenever you take a distribution from a pre-tax retirement account, those distributions are considered earned income. So it's, or excuse me, let me back up a little bit. Earned income in that you're paying FICA on it. I don't believe so. You know what? I might have to get back to everybody with that question. So if you have that question, please email me, because earned income is something very specific. It is considered ordinary income to you with that 1099, but I don't believe you can consider it earned income. So go ahead and email me on that one and I will double check. I'm not 100% sure on that. Okay, so going further into the Roth 401k and its benefits, you are wearing two hats in this scenario. And you'll see when we go further into the types of contributions that you are really making the employer contribution, you're making the employee contribution, and then of course the employee after-tax contribution. And even if you don't have a formally established entity, you can do this. So if you are a self-employed individual and you are a sole proprietor, you can still have a 401k. You're still wearing those two hats. And so, you know, it's a huge benefit because of the contributions you can make. The contributions are going to be limited based on how you file, and we'll talk about that as well. When you're making employee contributions, you have the opportunity to make $19,500 as Roth. So the employee contribution limit for 2021 did not change from last year. It's still $19,500, and that, what they call salary deferral, can be considered Roth or go directly into the Roth component of your 401k. And that's a huge benefit because if you'll recall, with a traditional or Roth IRA, you can only put $6,000 in. So if you want to get a whole lot more money into the tax-free growth portion of a retirement account, you can do that using a solo 401k and put $19,500. You also can do a catch-up if you're over the age of 50, and again, we'll talk about this, but if you're over the age of 50, of $6,500 for 2021, which means you can put $26,000 into the Roth component of your 401k for 2021. I mean, that's huge. So that's a really big benefit. You can also consider it tax deferred if you wanted it, you know, if you wanted that deduction and you didn't necessarily need it to grow tax free, if you wanted it to grow tax deferred. So that's actually an election you make at the time you make the contribution. So even if you elect to allow Roth elective deferrals or Roth employee contributions, you do not have to make those contributions as such. And if this year was a high earning year for you and you decide you want that contribution to be tax deferred for the deduction, you can do that. If next year you earn less and you're okay with it growing tax free and not taking the deduction, you can elect at that time that that contribution is considered Roth. So there's a lot of flexibility there. And like I said, employee contributions can be Roth, traditional, or any combination of the two up to the annual limit. The annual limit of employee contributions is much higher than the Roth IRA. Employer contributions are always pre-tax. I always want to point this out. It's very important because a lot of times when we hear Roth 401k, people immediately go, well, I want that one. I want the one that's completely 100% tax-free. And just the nature of 401ks, that's just not how it works. The employer contribution is always considered pre-tax or like a traditional IRA. But if your plan allows it, and the Advanta plan does, it can be immediately converted to Roth. So if you make your 20 to 25% profit sharing contribution from the employer and you want it to grow tax-free, immediately do that Roth conversion. Do the paperwork, take the 1099, pay the taxes on the amount you're converting so that it can grow tax-free. Not all plans allow that. So I always want to make sure that everybody understands that the contribution, or excuse me, the plans have to allow for these steps to take place. Okay, so here is a further explanation on the contribution limits, and this is important because I know We kind of said them out, we put it out there. These are what the contributions are, but I always think that this really helps you understand how they work. So for 2021, it did go up a little bit. It was 57,000 for 2020. It's 58,000 for 2021. The employer contribution is 20 to 25% of your earned income. I have an example of all of this on the next slide as well, so we're not going to use numbers yet, but 20 to 25% of your earned income. So that's what you've paid yourself for the year, okay? That's not necessarily earnings on the business, it's what you have paid yourself as an employee for the year. It's 20 to 25% of that amount. The next component is the employee contribution, Roth or traditional, and it's 19,500, and I forgot to change it, but it is 2021, it did not change, or 26,000 if you're over the age of 50. And then this third type of contribution, which allows the Mega Roth contribution we're going to talk about in just a second, is the employee after-tax non-Roth contribution. So that third type, again, it's going to be rare in solo 401ks. I'm going to be honest with you. And like I said, Advanta didn't even have it until 2020. So just make sure that your plan allows for employee after-tax non-Roth contributions so that you can make sure prior to trying to make that contribution. The other thing as well is that I like to be very specific here and call it an employee after-tax non-Roth contribution because it is not Roth. When you make that third type of contribution, unless you immediately convert it to the Roth component or move it to a Roth IRA, it is going to grow tax deferred. So for those of you that are familiar, it's just like basis in a traditional IRA. When you make a non-deductible contribution, it is not Roth, it is non-deductible. So the earnings attributable are going to be tax deferred, not tax free. If you want them to be tax free, your plan has to allow the Roth component. It has to allow in-plan Roth rollovers is what it's called, but we like to call it a Roth conversion. And you have to do the paperwork showing that you have done that in order to take advantage of tax-free growth. So let's use an example with some numbers here so you guys can really understand how the 401k contribution works. So John is a sole proprietor whose 2021 salary is $100,000. Here's the calculations for his contributions. How much can John contribute to each for 2021? So the employer contribution, and remember I specified here he's a sole proprietor, so he gets 20% of his earned income as the employer contribution, or many people call it a profit sharing contribution. So he can put in 20,000. As the employee, he gets another 19,500. And again, he can designate that as Roth. It can be traditional or any combination of the two, but the maximum as the employee is 19,500. And then his employee after-tax non-Roth contribution is 18,500. So what we've done here in this calculation is we've taken the 20,000 plus the 19,500. That brought us up to 39,500. But remember that the annual contribution limit for 2021 is 58,000. So we just took the difference there, and that's how we found out what the employee after-tax non-Roth contribution amount would be. So he's basically making up the difference. It is considered an employee contribution, so it's not an employer contribution. Remember, we just discussed that it's going to go in without a deduction, so it's a non-deductible contribution. It grows tax deferred until he takes an extra step, and we'll talk about those extra steps again in just a second. You want to make sure you understand that your contributions are based on your business's earnings. That's very important. Your earned income from the business and how you file for your business. The best person to help you with this is going to be your CPA. I can't stress that enough because we do have people call and say, why can't you calculate this for us? Well, there are so many things that come into this calculation that your CPA is going to have on hand, readily available. They already understand your business practices, how your business operated for the year. This is really not something that we can help you calculate. The employee contribution is a little simpler because it's, the first 19,500 of your earned income. But everything on top of that is going to be very specific to your business. So always have your CPA help you make these calculations so that you're doing it correctly. So the after-tax non-Roth contributions, again, your plan has to allow it. So check on your plan before making contributions. It is not a Roth contribution. Again, we've said that several times. Calculations, the annual limit minus the employer contribution plus the employee contribution equals what the after-tax non-Roth contribution potential is. You can immediately convert it to the Roth portion of the plan so that it'll grow tax-free. You must have the amount in earned income. Any contribution that you make, you must have that amount in earned income. You cannot contribute to the employer contribution, the employee contribution, the after-tax non-Roth contribution, your traditional IRA or your Roth IRA without all of this enough in the earned income. You have to have had it in earned income. And again, I know that when you are an investor, you may not have as much earned income, and much of your income might be passive. So again, you'll go to your tax professional and say, what can I contribute? What makes the most sense for me? Is it possible to bring more into earned income so that I can make a higher contribution? But you must have the earned income in order to make the total of these contributions. The 58,000, I had a question pop up. The 58,000 again is calculated by, and here we can go back to that slide. It's 20 to 25% of your employer, of your earned income by the employer. So in this case, John is a sole proprietor, so he didn't have a formally established entity. But let's say that he did. Let's say that it's, John's, I don't know, John's used books, which probably isn't even a thing anymore, but John's used bookstore. Well, if he paid himself $100,000, if John's used bookstore paid John $100,000, then he would have a formally established entity. And sometimes I think that's a little bit easier to understand. He might be able to contribute the higher amount. It might be 25%. It depends on how his business files. But that's, so if he paid himself $100,000, and again, in this scenario, we're using $100,000. It's 20 to 25% of that. If he's a sole proprietor, it's going to be on the lower end, that 20%. If he has a formally established business entity, depending on how it files, it's going to be on the higher end, the 25%. But the employer is doing a profit sharing contribution of $20,000 in this case. So that's from the employer. The employee is making the $19,500, and that number is based on the annual limit the employee is allowed to make. We got a grand total there of $39,500. Remember that the annual limit is $58,000. That just basically means that the IRS will allow you to put in up to that amount, but your calculation is going to end up being either $58,000 or the calculated amount. It's the lesser of the two. So the $58,000 is from the IRS. And then our employee after-tax non-Roth contribution is the difference of these two. So $18,500 in this example. And I hope that answers your question. But the $58,000 is a number given to us annually by the IRS. But that $58,000 is the maximum, but we're given a formula to calculate it. And if your maximum comes up more than $58,000, then the most you can contribute is $58,000 for the year. The only exception there is the catch-up contribution, which this year, if you're over the age of 50, you can contribute the maximum of $64,500. Okay, so we really already went over this. I want to see. Okay, so the next question I had is the employee after-tax non-Roth contributions for business owners only. That's a great question. The answer is it is not only for business owners. As a matter of fact, if you are a W-2 employee and your plan, now your plan again, even in, like, so for example, I contribute to my Advanta 401k plan. Obviously, I'm not a sole proprietor and I am a W-2 employee. Even if my Advanta plan allowed after-tax non-Roth contributions, it is actually still subject to discrimination testing. So you have to check with the plan and find out, first of all, if the plan allows those contributions and what the calculation might be for those contributions, because it is still subject to the discrimination testing. But that's a great question. If you have a plan that is not your own, you can still make those contributions as long as your 401k plan allows it. I had another question about the Schedule C taxpayer and not having a salary. It has to be earned income. And I'm not a CPA, so I want to just sort of say that first of all, but it does have to be earned income. It doesn't have to be W-2. It is some Schedule C. It can even be some K-1 as long as it's considered earned. 1099, of course. So again, this is where you want to get your tax professional involved, because that's going to be really important. It's typically what you're, or I should say, it is what you're paying FICA on. So if you're paying that self-employment tax, that's what you can use to calculate it. But again, getting your CPA involved is usually the best way to do it. Okay, so how does the Mega Roth work? I had another question pop up on the contribution amount, the 58,000. Is it for a certain age or marital status? No, the 58,000 is what you can contribute. I guess you could say per participant. So again, if you're self-employed, if it's you and your spouse or you and your business partner, 58,000 is per participant into the plan. It isn't based on age or marital status. But if you are over the age of 50, that's where that 64.5 or the additional 6,500 comes in. That is based on your age. So you can make that additional contribution based on being the age over the age of 50. And then the second part to that is the employee after-tax non-Roth allowed in a TSP? You have to check with the TSP. I don't know. They might have some, I know for sure that they have, like Roth components and things after tax contributions that are made at times to TSPs. You would just really have to check with them. And you can also reach out to me directly and we can discuss it, and I can kind of give you the information that you can go to the TSP with to find out. But that I am not familiar with. But it is not, it's not as simple as creating a traditional or Roth IRA. It is more specific to having an employer plan that allows the after-tax non-Roth contributions. I had a question in here. If you pay yourself a salary of 58,000, can you put 58,000 into the 401k? That's a question for your CPA. Remember, again, it depends on the earnings of your business. There is going to be some deductions you're going to take out of there. So I would get with your CPA to figure out how much you would have to pay yourself in order to make the full contribution, including the non-Roth after-tax contribution. So you definitely wouldn't be able to make it without that. But if you have a plan that allows it, you probably would have to pay yourself a little more, would be my guess, because again, it's the earnings of the business. There's some deductions involved before you can calculate it. So check with your CPA and have them help you with that. If your employer doesn't allow or doesn't offer anything, is there a way to make up that difference? So you have to have self-employment income to have an employer-based plan. So the solo 401k, the SEP IRA, or the simple IRA, those are all based on having self-employment income. So even if your employer doesn't offer any way to save, you can still have a Roth IRA or you can still have a traditional IRA. So you can make those contributions into those plans. But the employer-based plans with the larger contribution limits, those are based on being self-employed. Can you have a self-directed 401k plan for your business if you have two employees, if the only two employees are husband and wife? Yes. It can be business partners and spouses as employees. So that's important. Anybody else, including children, if they are your employees, you cannot have a solo 401k. But a solo 401k can be held if it is you as the business owner and your spouse as the employee. That will work. Okay. So let's talk about how you make your Mega Roth contributions. So remember, and I put the definition of a contribution up here again. Remember that a contribution is the amount you take out of your pocket and put into the plan, or your business does, because remember you have employer contributions. So calculate your after-tax non-Roth contribution. Remember, it's your employer contribution plus your employee contribution, subtracted from the total amount, annual amount for the year. So this year is $58,000. Step 2 is convert this amount to the Roth component of your 401k or distribute it to your Roth IRA if you are eligible. Remember that this step is very important, because if you don't take this step, when that after-tax non-Roth contribution comes in, it does not grow tax-free. It grows tax-deferred. So it's considered like basis in a traditional IRA. I believe you track it on Form 8606. I don't know that 100%, but I know with a traditional IRA, that is how you track basis. So check with your CPA to make sure that you're tracking the basis on the proper form if you do not have a Roth component, or if you cannot immediately distribute to a Roth IRA. That's very important. Then you would track the amount that's non-deductible, so that at retirement, when you take distributions, you're not taxed on it twice. So you either want to immediately convert it to the Roth component, and again, this is just paperwork really, but you want to make sure that you do the proper filing, or distribute it to the Roth IRA. I put if eligible here because you have to have a triggering event in order to distribute funds from your 401k to your Roth IRA. These events vary from plan to plan. So it might be years of service, it might be age. There could be a bunch of different reasons that you can contribute and then take distributions. So you want to make sure you're eligible. And then the next step, of course, is always checking with your CPA on any tax implications and that you're filing the correct forms, especially with a solo 401k, because keep in mind that with a solo 401k, if you're leasing a plan, the administrator is you, and you are responsible for filing 1099s, 5500s, and any other forms that are going to be important to that plan. So that's very, very important. So I had another question. Roth conversions of an IRA to transfer from a traditional, issue a 1099-R and ultimately pay the tax on the transferred amount. Yes, that is exactly how it works. Remember, the 1099 is to you, it's not to the IRA. So the tax burden is to you. When you do that Roth conversion, the 1099 is issued for the year in which the amount you convert is moved from the traditional to the Roth IRA. Okay. Qualified plan, IRA, both. You can have both. You can make contributions to both. You can utilize the Backdoor Roth strategy, and you can use the Mega Roth strategy. You have to have enough in earned income. As long as you do, you can do that. Remember checking with your CPA to find out if your traditional IRA will be, your traditional IRA contribution will be deductible. If it's not, it's considered basis when you do the conversion. It depends on whether or not you have other traditional IRA funds, but you may not have a huge tax burden there. But it is possible to do both. I know a lot of times in like the previous question, well, can I get by with just paying myself $58,000? The answer is probably not. You're probably going to have to pay yourself a little bit more. And if you plan on also utilizing the Backdoor Roth IRA contribution strategy, you're going to have to pay yourself even more. You have to have enough earned income to cover all the contributions that you want to make. So just make sure that you're going over that and finding out how much you would have to pay yourself this year to really take advantage of all of those contributions. So I wanted to talk a little bit about our events, because we have them going on all the time and they're always no cost. I did mention that this webinar I do feel is sort of an advanced strategy. And so if you're not as familiar as you would like to be with Roth IRAs and Roth conversions, we have a webinar on that. We also have a webinar, a brand new one that we just did last week, on solo 401ks. So again, if you're not familiar or not as familiar as you would like to be, please check out our YouTube channel. You will see both of those webinars posted. The Roth conversion we did back in December or late November, so you might have to scroll down a little bit, but you will see it there. And it talks about Roth IRAs and Roth conversion strategies, so that's very important. We also have events coming up. So for example, I have a webinar coming up on January 26th with a Florida probate attorney talking about Florida law and probate. It's going to be a great topic. I encourage everybody to join us. We also have our own Zoom style networking event on January 29th. All of this can be found if you go to advantaira.com/events. Join us for our networking. I think I learn something every time I join. There are people that join nationwide. It's an opportunity to meet like-minded investors, talk about investment opportunities or what you're maybe looking for. We also do have a guest for our next one on the 29th, and that's at 12 o'clock Eastern time. So again, advantaira.com/events. And I do see some questions popping up, which is great. Here's my contact information. I wanted to make sure that I get it back on the slides before I address some of these questions. And if you do have questions, now is a great time to get them in before we end here. If you have more than 2 employees, will the Qrp be an option that will work? So what happens when you have employees other than the partners and spouses is you do have to have a plan that allows employees. So you want to check in with a plan administrator that can do the discrimination testing that you will need. They also help you calculate contributions and everything like that. Now, those plans can still allow for things like self-directing. They can still allow Roth components. They can still allow loans. They can still allow after-tax non-Roth contributions. But you need to find a plan administrator. Advanta does not administer those plans that allows employees. If you need a referral, I would certainly be happy to help you with that. I do know somebody in the Tampa Bay area, but they can help anybody nationwide with those types of plans where they basically set up the plan specific to your needs, and they do still allow you to self-direct. I had a question here about modified adjusted gross income on a few different types of accounts. I'm just going to ask you to go ahead and give me a call because I think we could really dive into that and how it works. So go ahead and give me a call because across the plans, there's a little bit of difference and things of that nature. So just go ahead and reach out to me there. Can you convert an existing traditional IRA? Yes, you can. You can do a conversion of an existing traditional IRA at any time. That also applies to SEP IRA, money that you have in a solo 401k. An old employer plan can be converted. Typically, if you're a W-2 employee and you're still participating in a 401k plan, you're not going to be able to move those funds to a Roth IRA, but you can always check with your plan administrator to see if the plan has a Roth component and if you're able to do in-plan Roth rollovers or Roth conversions, as we like to call them. That will be entirely up to the plan itself. But if I have $100,000 in an existing traditional IRA, I can convert 10,000, 50,000, or 100% of those funds. I can do it today. I can do it over time. It's completely up to you. It's just remember that the amount you convert is 1099 ordinary income to you at the time that you do the conversion. I think I already addressed that. Let's see. The employer match goes into the traditional account of the 401k. Yes, the employer contribution, as we discussed on an earlier slide, is always going to be considered traditional or pre-tax, always. That's not specific to Advanta's plan. That is specific to all 401k plans. So if you want it to grow tax-free, the plan itself has to allow Roth components and in-plan Roth rollovers. So you want to check with the plan and make sure that it allows that. Is there any other questions? I didn't see anything new pop up. So again, I just want to encourage everybody to reach out to me with any questions that they have. Don't forget to snag the slides. They're in the handout portion of your control panel there, so you can download them. My contact information is here. I hope that everybody will join us on January 29th for our networking event. I would love to see you guys, and I hope you have a great rest of your day.